Hello and welcome to another edition of the Goldman Guide. If you haven't yet subscribed, please make sure you click the red subscribe button so you can be alerted to our uploads every week. Now, I was reticent to talk about the core topic today, and frankly, if you come from the industry as I do, you really are not supposed to mention it outside of conversations with colleagues and peers. But I decided it's been a bunch of years since I was a mutual fund manager and portfolio manager, and Wall Street analyst for that matter, so screw it. I'm going to let you know a dirty secret that can explain trading and help you position your portfolio for potential profits. Okay? Here goes. That secret is the fact that this period is essentially a scramble period for publicly traded companies and for institutional investors. I'm speaking of essentially the last week of the quarter. Now, actually, the scramble period likely began in earnest for many institutions a week or so ago. And I know what you're saying to yourself is probably, oh, it's just the window dressing that usually happens end of year. And while that is true, during the course of the year, it's done for a different reason, and it's a little bit more aggressive at times. Now, the institutions may have started a little bit earlier, or at least if they would have, it was because of the banking debacle that had occurred. And so, therefore, some of the sell offs that we saw in bank and financial related companies may have been exacerbated for the reasons I'm going to tell you now. Institutional investors sell big losers, especially those that are big names around this time of year. Why? Because when quarterly reports are issued next month, they show the top 10 holdings, in some cases, all holdings. And the fund managers just don't want to look foolish. Do they want to show big holdings, let alone any at all, in Silicon Valley Bank or Republic or Credit Suisse or a biotech that crashed because it didn't meet primary endpoints? They don't. Trust me. I know. I managed a mutual fund and small cap money, but I never engaged in such acts, although you'd be surprised how many do. The managers are afraid of redemptions due to poor performance and poor decision making in general. Makes them look like schmucks. And that isn't good for their bosses, for themselves, or investors. And publicly traded companies, well, let's just say that it's common knowledge that as quarters wind down, a number of leaders and executives bang the phones to try and get sales in the door that are pending. They work their asses off to ship as much merchandise as possible out the door, get purchase orders, or new service contracts signed. It's a big push. Early stage companies do it too, as relates to pilot orders or various arrangements. And you can't blame them. On the expense side, if they can defer expenses, they do that in some fashion as well. So why do they do it? It's pretty simple. They don't want to miss quarterly estimates and have their stock crater, right? So it makes sense. So now that you know this, what do the institutional investors do or buy during this period? Well, more on that in a moment. Let's do a quick review of some data. So first on the indices side of things, you can see that the Dow, the Russell 2000, they're still down year to date. Oil taking on the chin, and the VIX, which had a pretty strong couple of weeks with the up days we had last week, it's now essentially flat for the year. And on the RSI side, well, quite frankly, you could make the argument the S&P 500 and Nasdaq 100, seem pretty strong and are setting up buy signals at least for these perspectives. But these two here, Dow Jones and the Russell 2000, hate to use a common term, but let's just say these figures are kind of meh. And the forward PEs, pretty much what they've been for some time now, so nothing special there. Now with these figures here, just one quick note. We're going to be doing a bit of a feature on Bitcoin next week, so be on the lookout for that. Otherwise, nothing really too substantial to report here. But the key data, once again, are these fund flows. The AAII, we're almost at the 50% mark. That's all well and good. But here's what's crazy. According to Lipper, there were inflows of $12 billion, and the outflows, excluding ETFs, were $2.8 billion. That means that a bunch of money were generated and put into ETFs. So we did a little corollary, as we always do, and on ETF.com, there was a huge amount of inflow there. As a matter of fact, the top three ETFs had $20 billion invested in them alone in the previous week. Now, SPY, QQQ, which of course is NASDAQ 100 and S&P 500, Spider, they helped lead the pack. They were two of the top three. The outflows were diversified in a bunch of different areas, but they were interestingly enough led by ESG, which you would not think would be the case given the current administration. But obviously, people are not too fond right now of anything on the green side. Total market and then some dividends, and this of course relates to interest rates. Now, with that said, what does this fund flows data tell us, and how do the FANG stocks relate to it? Because in a sense that they do. So the fund flows data tells us the following: that at the end of the month, some of these institutional investors were selling their big positions, and because they need to be fully invested or close to it, they put it when they could in these ETFs. In other cases, they bought other stocks, I'm sure. But that is one thing that's indicative of that as well. And on the FANG side, something very interesting. If you looked about a month ago when stocks were cratering, almost to the day, um, you could see that the performance of the FANG stocks were up 28% year to date. 14% year to date. Yet in the past month, where we've had all the crazy volatility, now these stocks are up an average of 28%. This group has doubled. Now, granted, most of it is Facebook or Meta, a little bit of Google or Alphabet, but still, it tells us that there has been a flight to quality. Another reason why we have these big inflows into the Spider and QQQ. There is an absolute flight to quality going on here. You can see it with the RSIs, also with the S&P 500 and NASDAQ as well. Now, what do the underlying new ETF investments that I'm speaking about in redemptions portend? It means that for the near future, bigger is better. So just keep that in mind for now. It doesn't mean it's going to be that way all the time, but certainly as we head into next week, next month as well. Is the major hurt in the banking sector over for now? I would say that largely yes. Could see some drips and drabs this week, but I think largely yes. Should I invest like an institutional investor? I would say to a degree for sure. Hey, if it's going to work for them, it can work for you, and we'll talk about that in a second. And then last here, will inflation or company earnings affect near-term performance? And here I'm relating to the market, and they absolutely will, but only on a limited basis. I think right now it's going to be more on the company earnings side as we're heading towards the end of the first quarter and the beginning of the second quarter next week. But more on that when you look at and when you consider where the money's headed or where it's not. So as I said a moment ago, the big ETFs, they're in play, no doubt about it. Especially Spider, SPY. What else is attracting money? Anything that has the two letters AI in it as an artificial intelligence or machine learning, clearly it's attracted lots of dollars. If you look at the performance of the Nasdaq Composite and the Nasdaq 100 so far this year, it's up strongly, and part of that is because of AI. Nvidia has done extraordinarily well, and some of the other technology companies are helping to keep that index, or both indices rather, on the technology side, far above everyone else. So the broader market really not doing that well, but in these specific narrow areas, they certainly are. And we talked about FANG a moment ago, and I think that these stocks will continue to attract money, but not all of them necessarily. I don't think that Apple and Netflix are going to be particularly strong here in the near term. Now, where is money headed? Technology, as we're referring to, and I think also technology on the small company side as well. Oil and gas, even though oil prices are down, this is actually a good time to buy. And given what we've already seen, redemptions and outflows in ESG, I think that's probably going to continue. Although we've been big fans of VIX and VXX, we had our little run already. And what usually happens, quite frankly, when a new quarter starts, stocks tend to go up. If the stocks don't go up the first week of the second quarter, it's not going to be a good sign for the rest of the quarter. And I think we are going to see some improvement and people feeling a little bit better about volatility and a halt in the raising of interest rates later this year, which will do well for stocks. So in the meantime, I'd avoid financials. I'd avoid biotech because of the financial crisis, and we've talked about that before, how these two are kind of interrelated. I would avoid some consumer discretionary companies, again, because of inflation and layoffs. This is for the moment, but I think as we get into the second quarter, we're definitely going to see a little bit of a change there. And that's why what will go up must go down first. I think we're going to see some of these things go down first and then rise later in the second quarter. So, let me take a breath here. All right. Well, that's going to do it for this week. Thank you very much for listening, and we hope you enjoyed learning what the new dirty little secret is. And if you have any thoughts on our ideas, shoot me an email at rob@goldmanresearch.com, and don't forget to hit the red subscribe button, become a subscriber to our ever popular Goldman Guide. Take care, and we hope you have a very nice week.